The spectre of a banking crisis returned to haunt markets in March, with the collapse of two mid-sized banks in the US, Silicon Valley Bank and Signature, as well as the fall of the much bigger Credit Suisse into the hands of its rival UBS, a transaction orchestrated by Swiss regulators. While there was no direct contagion between the banks, it's clear that the dramatic shift from ultra-loose monetary policy to the highest policy rates since the global financial crisis, tightened liquidity, rising bond yields, and a steep inversion in the yield curve played a significant part in each of the failures. Banking sector share prices inevitably suffered large falls, with the MSCI World Banks Index down 16%, wiping out gains from earlier in the year. Bank debt was also hard hit, particularly so-called AT1 contingent convertible bonds, due to the Swiss regulators' decision to wipe them out for investors in Credit Suisse, while still rescuing some minimal value for equity holders, which created uncertainty over the hierarchy of corporate stakeholder seniority amongst European financials. There were significant consequences for broader bond markets as fears of recession rose and investors priced in early cuts in the US Federal Reserve and other central banks' policy rates. In early March, the 10-year US Treasury bond yield was around 4%, but within a few days had fallen to 3.4%, where it still stands now in early April. Market pricing for US inflation over the next 10 years held steady over the quarter at around 2.3%, meaning that most of the move in longer-term bond yields was driven by falling real yields. However, nothing suggested acute distress across the banking sector or among investors generally. The US bank failures were idiosyncratic in nature, with both suffering from concentrated client exposures which led to a run on deposits, while Credit Suisse paid the price for seemingly endless problems and poor management over a long period with weak profitability and falling assets. Regulators in the US and Europe responded rapidly and forcefully to arrest contagion risks, with full protection provided to depositors of the failed US banks, as well as making substantial liquidity available to US banks through a new term lending facility. Following the Credit Suisse failure later, other central banks joined the Fed in coordinated action to ensure sufficient liquidity in US dollars globally. While further casualties of the increasingly tight monetary policy cycle are possible, and probably inevitable, we see no parallels with the banking crash which led to the global financial crisis. There are no systemic risks arising from the collapsed banks, and the prompt action by central banks and regulators has minimised contagion risks. Furthermore, the tightening of regulations post the GFC and more conservative risk management of banks has resulted in much stronger balance sheets, bigger capital buffers, and greater resilience. Looking at market returns over the month and quarter, after the initial shock in March, equities mostly regained the lost ground, leaving the US market up 3.6%, while global developed and global emerging market equities were also up by around 3% in dollar terms. This capped a strong first quarter, with the US market gaining 7.4%, global developed equities up 7.7%, and emerging markets up 4%. Meanwhile, the big falls in bond yields resulted in strong performance from government bonds in March, with US Treasuries returning 2.9%, ahead of high yield and emerging market bonds, which gained 1 to 2%. In an unusually volatile period for bonds, over the quarter, global government bonds returned 3.1% in dollar terms, with corporate investment grade and high yield bonds generally outperforming safe haven government issues. Looking forward from here, markets face a difficult conundrum. On the one hand, interest rates are at or very close to a cyclical peak, and bond yields have fallen sharply in recent weeks, supporting valuations of other asset classes. While on the other hand, the risks of a recession in coming months have increased materially, with the inevitable consequences of credit contraction, earnings weakness, and higher default risks. While less attractive than a month ago, there are still valuation opportunities in government bonds, as well as other parts of the fixed income sector. And for the first time in years, cash is a viable instrument to achieve target returns and manage risk in multi-asset portfolios. Equities also offer some valuation opportunities, but are overhung by the risk of recession and earnings weakness in the short term. Recovery lies ahead though, and we're optimistic for markets over the next 12 months. But we believe it's prudent to temper that optimism in the short term, given the heightened risks of recession. We are therefore taking opportunities to add to defensive assets in real, inflation-linked and nominal bonds, while biding our time before adding to risk assets further.
The Harmony multi-asset portfolios had mixed performance over the month of March, as more dispersion crept in across the different regions, creating a mixed set of results. The sterling portfolios were the weakest, with Harmony sterling growth marking 1.8% lower over the month, whilst the dollar portfolios polled the best performance, with Harmony US dollar growth up 1.2%. The Momentum Global Equity and Sustainable Equity funds returned 2.4% and 2.7% respectively. After the first quarter of the calendar year, all portfolios are up, with Global Equity and Global Sustainable Equity leading the charge, both up nearly 7%. Going back to look more closely at the regional performance, blue chip UK equities fell more than 3% in March, small and mid caps even more. Whilst despite all the noise about banking runs and collapses in the US and Switzerland, the S&P still managed to finish 3.5% higher. And that's after the banking sub-index fell in the high teens. This is because the index is again being driven higher by a narrow cohort of tech stocks that have performed better as rates have fallen. The Nasdaq was up 6.7%. Asia and emerging market equities performed almost as well as the S&P, with Japan and Europe posting lower but still positive returns. It was a much better month for bonds as markets priced in a much softer forward path to rate hikes. And with real and nominal rates falling and whack-a-mole banking issues in play, it was no surprise to see gold flying higher, coming within a whisker of its all-time high of $2,060 an ounce. In the Harmony portfolios, we did make some changes during March, selectively taking some profits on our precious metal positions, trimming gold slightly, and taking out silver where we owned it after a strong recent run. We also took out most of our sterling credit where we owned it, having made the most of the opportunity presented to us after the disastrous UK mini budget back in September. We recycled the bulk of this bond and real yield beta into European government bonds via the iShares Euro Government Bond Climate ETF and into US Treasury Inflation Protected Securities, or TIPS as they're better known. Yields on European govies have come way up over the last year, now at around 3% in euro terms, and you can add another 2% when hedged back into dollars, and over 1% back into sterling. So we feel this is attractive for the first time in years, both for the yield it offers and the ballast that bonds can now provide again. And it also diversifies our existing bond exposure. On the tip side, real yields on 5-year bonds were getting near 2% again in March, which we think is a pretty good return after inflation. We bought some higher yielding, shorter duration tips and paired these with a longer one we already own in portfolios. Overall, credit risk went down in portfolios and interest rate duration went up. We also reduced our exposure to Schroeder Real Estate Investment Trust, and in the sterling portfolios used some of these proceeds to fund a position in Life Science REIT, a new investment trust property holding which leases laboratory space to tenants operating in the life sciences sector, much of which is situated in the Golden Triangle between London, Oxford and Cambridge. April has started on a mixed footing at the present, but we'll update more on that in the coming weeks in the next Harmony video update.